Hi, my name is Trevor Carlson. I'm the president of Heritage Reverse Mortgage. We are reverse mortgage specialists, and I wanted to record this video to help you decode your reverse mortgage statement. If you have a reverse mortgage, you've probably seen how confusing that monthly statement is. And so let me walk you through some of the things that are on there and help to clarify what it is you're looking at. So the first thing we want to do is let's look at the key terms associated on these, or the key terms on these statements. The first one you're going to see a lot of is called principal limit. Now, the easiest way to understand this is principal limit is another way of saying borrowing power. When you set this loan up based on your age, the interest rates, and your home's value, you were given a max amount that you could borrow, or a principal limit. Now, as time goes on and your age gets a little bit older and your home value goes up and those kinds of things, your principal limit actually increases, and it always increases, it never decreases. So keep that in mind. But that's why you'll see on your statement various lines that say things like current principal limit, growth principal limit, those kinds of things, is because your actual borrowing power on the loan could be increasing. And so let's come back to that in just a moment. The next line is the current total loan balance. Now, this is what you actually owe on your mortgage. And so it's very common that you could see that your total loan balance is actually less than your principal limit. Again, this is because you have not used everything that you have available to you with this mortgage. The next line that comes up a lot is the line of credit. Depending on the type of loan you did, if you did a fixed rate reverse mortgage, you have no line of credit. You cannot borrow any more money after you close the loan. But on a line of credit or a growth line of credit, you can actually access some of your equity down the road if there's any remaining available on the mortgage. Mortgage insurance, or MIP, is commonly seen on the statements. This is what FHA charges for insuring these loans. And the purpose of this insurance is to make sure that, well, it's a risky loan. The odds are slim, but it is possible that you could live to be 120, your mortgage could go upside down, and this could create a loss for the bank. And so because of this risk, FHA has to create, or has to provide, insurance that would shore the bank up if you did outlive the equity that was in your home. Interest, of course, this is what the bank is charging for issuing the loan to you, and it's paid to the bank. Servicing fee, this is an interesting fee because it's not charged by all banks, and in my opinion, I think it's a junk fee. It's not necessary. The bank's essentially charging you an extra $25 or $50 a month for the benefit of sending you a mortgage statement. And so if I were you, if you see that there's a service fee on your statement, call your lender, see if you can get that removed, because again, in my opinion, it's an unnecessary charge that some banks will throw in there. Repair set-asides. This comes up pretty rarely, but occasionally we'll have a client whose home needs work on it, needs to have some work done on it before we can close the loan. Maybe they need a new roof, or they need a new water heater, something of that nature, but we don't want it to hold up the closing of their mortgage. And so we'll close the mortgage, we'll set aside a few $1,000s to perform those repairs, and then once they're done, we'll release that money, and then the homeowner can pay off the expense of doing those repairs. Tax and insurance set-aside, or another word for this is LISA, life expectancy set-aside. Essentially what's happening on this is very similar. The bank is taking a portion of your home's equity to pay for your property taxes and homeowner's insurance on an annual basis. And so either they'll pay those expenses directly to the appropriate parties, or oftentimes they'll send it to you, and you still need to pay those expenses to the county and to the insurance agent. Typically, this is voluntary. You can put it on there voluntarily. Sorry, let me correct that. You can have a LISA voluntarily if you want one, but in most cases when a LISA is involved, it's because there may have been some credit issues when you did the loan, maybe some late payments on some debts, or a bankruptcy or foreclosure, something like that. The reason this exists is because they just have to ensure that your taxes and insurance and other expenses are being paid on this property, so that you can never be foreclosed on. Let's jump into the first statement. This is by far the most common, and I'm trying to go kind of quickly so this doesn't turn into a super long video. But this statement that you're seeing here is the most common version of the reverse mortgage, and this is used by C-Link, Longbridge, AAG, Finance of America, Mutual of Omaha. Most of the big reverse mortgage banks follow this type of statement, but we'll get into a couple of others that are common as well. So on this statement, things that I've highlighted here are the things that probably mean the most to you. Number one is, who do I call if I have questions? my recommendation here is always go back to your original lender or loan officer. And so, for example, I'm a broker, and so I lend through about 7 different banks, and so I don't actually service loans for my clients. But I do always tell my clients that anytime you have a question, please call me. And that invitation is open to you as well. Even if I'm not your loan officer, if you have questions on your mortgage, you can call me. I can usually answer a lot of those questions, or I can get you in touch with somebody who can. But if you want to call your lender, here's how you do that. Up here in the upper right-hand corner, you have the customer service phone number, usually an email and a website. Going below that, you'll have your account number, which show up here. I've whited it out for obvious reasons. And then this section right here will tell you what kind of a loan you have, whether it's a fixed interest rate or a growth line of credit. This is where that will show up. Now, getting into the nuts and bolts of this, let's start on the left side of this, right under where it usually says this is not a bill. You'll have 2 boxes, the left side and the right side. The left side talks about the loan balance and the principal limit. Now, the principal limit, as I mentioned, in this situation, this homeowner had an original borrowing power of $103,750. As time has gone on, she's gotten a little bit older, and that borrowing power has increased by about $2,000. So her current principal limit or borrowing power is $105,000 or almost $106,000. But here's the difference, is that her current total loan balance is only $75,000. And so that means she's only used $75,000 of her $105,000 that's available. Now, the beauty of this, excuse me, the beauty of this is that with reverse mortgages, if you have a growth line of credit, that money just sits in there and waits for you to access it. And so going down the rest of these lines, again, right here you'll see the servicing set aside. You'll see a repair set aside if you have one, tax and insurance set aside, and then your current net principal limit. So let's jump over to the right box and bring all of this together. In this situation, as I mentioned, she's only used $75,000 of her total $105,000 available, which means she has a line of credit of $29,590,000 when we started the loan. But the neat thing about the growth line of credit is that if you do not use all of your line of credit, it will grow automatically by the same interest rate you have on the mortgage. And so she's not touched that $29,000. As a result, they've added almost $1,000 to it. This is additional money she can draw out at any time. And so right here on this line is her current available line of credit has grown from $29,000 to $30,000. And so it's increasing over time until she actually needs that money. Okay, on that same statement, usually it's page 2 or 3, you'll also see your interest rate information. And so, again, I think they give far too much information here, which can be really, really confusing. And so let's dive into the things that really matter the most to you. The first thing here is they give you 3 lines, a daily, a monthly, and an annual periodic rate. The annual is really the only one you're looking at here. It's the only one that really matters. It's what most people understand. These columns, these are the various breakdowns of those interest rates. And so you have your mortgage insurance rate, which right now is generally 0.5%. If you have an older reverse mortgage, it might be 1.25%, but the vast majority of reverse mortgages are at 0.5. That's on an annual basis, and again, that's what's going to FHA and HUD. The index and margin are the calculation of what the lender is using to determine your interest rate. The actual loan interest rate is over here on the far right. And so, again, right here, this bottom far right corner, that's what your total interest rate is. And then right below that, you'll see if you do have any adjustments coming on your mortgage, it'll tell you when and what will be changing. Right now, interest rates are coming down, and so you're likely going to see some improvements on your statement from month to month. Another section here that may be of interest to you is the periodic information. This will show you in detail how much you were charged last month for mortgage insurance, how much interest you were charged that went to the bank. Again, you're not paying any of this, it's being added to your loan balance, but this is how you keep an eye on how much is being added. This is the next most common statement. This is a NOVAD or PHH is what most people will have as a lender with this statement. And really quickly, I'm gonna zoom in on this to make it a little bit easier for you to see. But a couple quick things to point out here is in the upper right-hand corner, you have your interest rate information. And it usually will tell you right here, interest rate type, fixed or ARM. It'll give you the interest rate right here. And again, if the margin is all zero, that's just another indicator that you have a fixed interest rate. Over here in the left, this shows when your loan was taken out. It'll give you your basic information for the home and property. This bottom left corner, this would give you your line of credit information. Again, if you have a line of credit, it will show you here how much is available, how much it's growing, and those kinds of things. And then in the bottom right corner, again, we talk about the original principal limit or borrowing power, current principal limit, current borrowing power, and then your actual loan balance. And so again, it's just showing you how your loan is growing over time and how it's adjusting. Just below that, you'll have this section, which again is highlighting the month-to-month changes of how much you are charged for interest, how much you are charged for mortgage insurance, what your total loan balance is at the end of the year. Likewise, you'll have year-to-date information on here as well if you want to see that. This is a PHH statement, almost exactly the same. Biggest difference is that sometimes they swap these boxes, and so instead of your interest rate information, instead of being up here, it'll be down here in the bottom left. And so same information, just kind of flip-flopped a little bit on some of that. This is the last statement that I'll cover today. This is Champion Mortgage. They're the only ones that use this statement. It's not a great statement, and so it is kind of confusing, but let me kind of walk you through some of this too. Your interest rate is listed right here under the account overview. Again, they give you the daily, monthly, and annual. The annual is really the only one you need to worry about. Your current monthly principal limit, current loan balance, servicing fees. You can see, again, Champion does usually charge servicing fees. Another reason why I'm not a big fan of them. Available line of credit would be over here, and then your tax and insurance set aside, which we've mentioned before, and total loan balances here. Now, I mentioned before that yes, I have preferences as a lender. I lend through a lot of different banks, and I come across a lot of different banks with all of the clients that we work with. And so, of course, I have some, I have my favorites and my not favorites. And so for everybody that has a reverse mortgage, a lot of people think, well, it's a set it and forget it. Once I've set up, I don't have to worry about it anymore. And that's true to an extent, but what I would say is that if you ever have the opportunity to refinance, should you? And my answer is a resounding yes. Yes, you should refinance. There are a lot of reasons why you might want to refinance your reverse mortgage. So let me just give you a quick snapshot of what those usually are. Number one is a better interest rate. Interest rates fluctuate constantly, and so if you have a high interest rate and rates are coming down, absolutely watch for a better interest rate so you can save yourself interest charges. You can protect more of your equity for your family. This means that they inherit more of your, more money when you pass away. Or if you need to sell this home and move into another home down the road, you're protecting more of your equity for yourself and keeping it out of the bank's hands. So lower interest rates is key. Lower mortgage insurance rates is also a big one. Again, it doesn't vary very often, but mortgage insurance rates do periodically change, and so you want to make sure that you're at the lowest possible rate available. Additional funds. As time goes on, your home value is going to go up, interest rates may come down, and this would allow you to borrow another $20,000, $30,000, $40,000, $50,000 from your home's equity. You don't have to take that money, but you can establish it in your line of credit so that it's available for you. And so again, it becomes just a great reserve account for you for some future occurrence. Reduced costs. The nice thing about refinancing reverse mortgages is that the vast majority of your expenses paid up front will transfer through to the new loans. For me and my clients, I typically try to help my clients refinance as easily as possible. And I can't guarantee this for everybody, but generally we're trying to get their costs to very low, if not zero, for the vast majority of people that we help refinance. We want it to be a no-brainer for you. If you have a reverse mortgage and we can improve it, let's do it, but don't spend another $10,000 doing it. Let's just reset the loan, keep those costs low, and let you maximize the benefit you're getting from this loan. Likewise, updated terms and protections. Because FHA monitors this loan so much, they're often changing the terms of the loan, and so it might be beneficial for you to add additional protections for a spouse or a new spouse or other family members. And so just updating the loan to the current loan terms could be beneficial. Bottom line is that we're refinancing to make a good thing better. If you have a reverse mortgage and you love it, if you're refinancing it, it's because it's making it a better loan. Now, this is my contact information. Again, as I mentioned before, even if I'm not your loan officer, I did not do your reverse mortgage, I am still happy to help. If you have questions on your mortgage, you can always call or email me and I would be happy to answer those questions for you. If you're just looking for an active loan officer who knows what they're doing and wants to watch the market for you for opportunities to refinance, again, that's what I'm here for. I am actively working on this every day. I help my clients to watch the market so they don't have to worry about it, because that's what I do. When the market improves, interest rates go down, values go up, I actively will contact them and let them know it's time. Let's pull the trigger on your low or no cost refinance to improve your loan. If you want to be on that list, if you want to receive that benefit, again, just let me know. I'm happy to include you if I'm licensed in the state where you live. And so, again, thanks for your time. I hope this was so helpful for you. If questions remain, just let me know. We'd be happy to help you even further. Thanks so much.